Who does know what a backdoor listing is? Don't be shy. Okay, cool. So we're going to learn a lot about it today from these three people. If I can introduce Rocco Tassone, who's the Director of AppLab Technologies, listed investor and app developer. So they invest in app businesses, and they also have their own. So they have develop their own app businesses and their own investment arm, as well as being their own app builder as well, based in Subiaco. So Rocco had 8 years experience from Bell Potter Securities. Him and his fellow directors all came out of there, so we're looking to broking deals. Now they've been very much in charge of the deal and the set of the deal. But most importantly, Rocco is a past New York pizza eating champion. So good to be welcome, Rocco. Steve Rice is someone who's been around the startup community, notably eGroup and other things for many years. Global mind screen, web development companies that he's bought and run. And most recently did a backdoor listing himself, and is the CEO of Spookfish. And they've just had a major win, I hear, in the Supreme Court. That's why he's got a big grin over his face around his technology. And also, you might not know, and if you really get to know him, you'll see the scars that prove it around his knee. He's a past footy champion, a schoolboy champion. Is that right? So welcome to Steve. Tim has been involved in the management of listed entities for a while, and is here today to really talk about that side of it. So we've got sort of Rocco, who's actually done a couple of backdoor listings himself on the broker side. We've got Steve, who's actually just done one as a CEO, and you've been involved, Tim, in the sort of management post-listing in various entities and been around the technology side. And I forgot your quirky fact. Oh yes, you like zombie movies. Yeah. Is that right? Yeah. Okay, so welcome, Tim. Do is we'll have give them 5 minutes each to tell you about their experience of the backdoor listing environment, or sometimes known as the reverse takeover environment, going into maybe an empty shell. There's quite a few of them in West Perth, mining companies that technology companies can reverse into. And I suppose a quick way, it's a quick way of getting onto the ASX. Is that really the good definition of doing it? Cheaper way, quicker way of doing it? Is that sort of layman's term? Yeah, okay, it's obviously got some advantages. Disadvantages. So, Rocco, over to you for 5.
Thanks very much for that. Thanks everyone for coming in nice and early, and thank you very much to Charlie. So I guess probably just touching on first of all, my name is Rocco Tassone. I'm a non-executive director of AppLab Technologies and XTB Networks, which is both recent backdoor listings. I'm also an executive director of GTT Ventures, which is a sort of a corporate advisory venture capital investment firm specialising in RTOs. In AppLab Technologies, we made about 3 strategic stakes in mining shells. The first one was in Intercept Minerals, which is now XTB Networks. The second one was Liberty Resources, which we're now backdooring in Cirrus Networks, which is raising about $3 million. It's an IT solutions integrator. And then the last one was GB Energy, which we are currently looking for in a particular asset there. So that's, I guess that's sort of the history of sort of the backdoor side of things. Going into, I guess, sort of what Charlie said, probably the term backdoor listing, I'm not exactly sort of too sure where that came from. I guess sort of the more technical term is reverse takeover or RTO. I guess sort of, I'll let you draw your own conclusions why someone thought the backdoor was a bit easier, but it's...
a negative conversation, maybe?
Yeah, it kind of does, yeah, I guess. Potentially that may have been the case once upon a time, that backdoors were a lot easier. However, nowadays, it's actually there's probably as many, if not more, challenges now to an RTO as opposed to an IPO. With an RTO, to execute a successful RTO, you're probably looking at about minimum 6 months. You could probably get an IPO up and done within 3 months. So that's probably, I guess, that's sort of more from the regulation side of things and sort of what's been introduced. And like anything with the regulators, the more that something happens, the more they're going to look at it, the more they're going to scrutinise it. So it does take a lot more time. I guess my speech is sort of more from a corporate side of things. So trying to look at, there's actually no hard and fast rule with an RTO. When should you backdoor, or if you should backdoor, there's no rules regarding that. If the market likes it, you think you can raise money, then you might as well go for it. I mean, I'm sure these guys will tell you, and you've sort of seen some of the things that have been raised money for nowadays. I think in this market, you can pretty much raise money for anything tech or anything unusual. You can pretty much get it over the line on the boards. So I guess I'll just quickly run through, 4 components that you're going to encounter when you are looking at an RTO. Is the valuation of the shell, the valuation of the actual vendors, due diligence and compliance, and the capital raising. So the valuation of the shell. pretty much most, if not all, the negotiating is actually done obviously pre the announcement. And at that point there, you actually need to work out at what valuation the shell is going to be placed at, what deal the shell is going to be done. So for example, if the shell has a market capitalisation of $3 million and there's $1 million in cash, you're effectively doing a deal at an enterprise value of $2 million. So actually $2 million is probably, I'm not sure whether it's probably round about sort of the mark sort of nowadays for sort of actually getting into a company. So what that means is the vendors are effectively paying $2 million of equity in their business just to, one, be listed on the ASX, and two, just to get rid of the old directors. So I guess in principle, the vendors want that shell valuation as low as possible, whereas the directors want that valuation as high as possible. Obviously less dilutionary there. So the second part is the valuation of the vendor company. I guess it's important to get the right valuation. Like with anything that you're buying, you don't want to pay too much, and that's no different here. So some of the risks you encounter if you actually do pay too much for a vend stock is, one, you may not actually go ahead and be able to raise the money, and two, you're effectively setting yourself up for a hammering on the ASX, because nearly everything has a comparison, everything has a valuation, so therefore once you are listed, you will then be compared against your peers and effectively sold off should you be valued too highly. So in my opinion, it's probably one thing we do look at. We do try and make the vendors take as much stock milestone based as opposed to upfront. Every director will come in and tell you that their business is going to be worth $100 million one day. So get them to put their money where their mouth is, and happily, if they hit their milestone, they're actually able to get more stock. That's sort of how we look at it. So on the flip side of that, the vendors want the valuation as high as possible, and obviously the shell wants that vend valuation as low as possible. Compliance, from a compliance point of view. Now, this can, once a deal is announced between the shell and the actual vendor company, there's usually a 60 to 90 day DD period. This is quite a costly period in that fact there's legals and then there's accounting fees, but it's also quite a time onerous task in the fact that the shell company then sets up a DD committee, and there is just a number of checkpoints that must be signed off. So the ASX nowadays requires an independent accounting report and all books to be audited. So from that point of view, that's actually quite a once again that's sort of quite costly. That alone there is about a $50,000 exercise. Sorry, one second. Yeah, that's right. And also then, once again, it then depends on, the ASX may also ask you for a IP or a trademark report, depending upon the asset. They might also ask you for an independent expert report. So BDO's just released a paper in regards to independent expert reports just recently. So I encourage you guys actually to have a read of it and have a look. So basically it's just both companies going through each other's books and just making sure that there's absolutely no skeletons in the closet, because certainly with the shell there's lots of skeletons in that closet. Capital raising. If the valuation of the company is right and the message is correct, then the capital raising is probably the easiest part of the whole process. Nowadays, to be listed on the ASX for a startup with no history of earnings, you must have $3 million in net cash at day one of listing. So, yeah. And,
that's a good overview. Thank you very much, Rocco. And I think there's been about 18 backdoor listings in the last 6 months in WA alone. And the last week, Business News heard of 5 that have just been announced, ranging from 2 million to an 18 million raise. So it's certainly a lot of people are looking at this sector. Now, Stephen, you've been through it. I think you've got a few slides, so we might just duck out the way with those slides ready. Steve's going to take you just 5 minutes, a little bit about the Spookfish story.
Before we get to the slides, I might just, as Rocco has really given us a good overview of the practicalities of what you need to consider for backdoor listing. I'm going to come from a business perspective. I've focused on the disruptive space for now 20 years, innovation and technology. And why have I done that? Because I think that's where the money is, that's where the excitement is, and that's where the learning is. Don't always get the trifecta. Let you know. We've often made money, and a lot of the times we've kind of just got the learning. If you just get the learning, you don't get the trifecta, and you go on to the next one. Some of the projects that I've been involved with over the years, and just to give you the breadth, and I've kept them all private, but this one that I'll go through in a minute as to why we kept that public. Mental health, anyone know the size of the mental health market globally. It's $1.6 trillion, the impact. It's the largest disease burden on the planet. We came up with a online assessment system. We've now got a B2B, B2C, B2W and a white labelled telehealth channel, 37 countries. It's from the farming community. 25% is lost in the supply chain. It's 14 levels long. There's 9 stages of manual input. So there's incredible stages for error. And so we built an online system that went from farm gate to export, and it's online with an online auction system. Didn't get the trifecta on that one. There's others, screw caps for the wine industry as distinct from cork. Didn't get the trifecta on that one. In Australia, yes, but not globally. We converted waste product from breweries and dairies. They even paid us to take it away. We used genetically modified yeast to convert that into biofuels, nutraceuticals, etc. Got the trifecta on that one. So, you know, each one of those have been kept private. I got introduced, 4 guys came to me and said, we've got a technology that we built before. It's a massive industry globally. We've now got a new version of that technology. We didn't get the payoff we wanted the first time. Can we do it again a little differently? I looked at it, and when someone comes along and says, we can deliver 1 centimetre pixel size when the rest of the market's at 30 for satellites and 7 to 10, and we can do that from 30,000 feet when everybody else is playing around 6, 7, 8, 10,000 feet, some are at 1,800 feet. They all get trashed at the airports trying to get up into the air. Obviously, the priority goes to the jet airliners and then the freight companies. We're way above that, so we don't have that challenge. What we can do is cover 30,000 square kilometres a day. When Google's at 3 centimetres, when Google's doing 15 centimetres and that little tiny bit in red, and Nearmap, one of the other competitors, is doing 8 centimetres and a little bit more. Gives you an indication. If you fly higher, cover more, the swathe is bigger, shows it there. We invented our own cameras and sensors, and you can see the difference of what's out there in the marketplace to what we're now doing. So when someone comes along and says, that's what we've got, let's look at the complete value chain to take it to the market. So how big's the market? It's $270 billion globally. It's a very mature market. It's been going for a long, long time. It's a bit like if you think of televisions. Everyone has a television, but most of the players are in black and white. Some of them are in that old big box colour, and we've got this brand new 60-inch, LED or digital television. So why did we backdoor list that when I haven't done that for the others? We did the due diligence on these guys and the project, and put some money in, raised some money, seed capital, and we actually got them to build a technology roadmap. It took us about 6 months. At the end of that, we said, what do we need? We needed $42 million. And we needed some serious risk money. And having a track record or just saying that, oh, look, we can build it. People don't generally throw money at you, do they, Matt? So, what we needed to do was find some way of accessing, 1, the risk capital, and 2, securing our future. The backdoor listing, what we did there was an appetite change around about Christmas 2013, moving into 14. The mining industry had come off the boil. There was an appetite for tech. We picked the market right. We then started to look at which shelves were available and how we would go about it. I have never done a backdoor listing, so there's the start of the trifecta is the learning. So that was a pretty big learning curve for me, even though I was kind of the independent chairperson at that stage, and then I invested and more money and sort of joined the board and we went from there. But in choosing the right shell, we went through 8 in Perth, 8 mining shells to look for the criteria. You learn pretty quickly that what you need is a shell that's got cash. You need directors that are willing to do a deal, and you don't want options. That screws up the whole financial structure. In my opinion, it's got to find it a little bit differently, but I didn't want any share options or issue. Most importantly, we find the people that will be willing to do the deal. At the end of the day, it's the people that you get in the room and make this work. We had targeted, I'm sure you won't mind me mentioning his name, we targeted Tony Grist, chairman of ANCOM, had done a lot with INET, very big in the tech space, had a great name around town. So before I went to any of the shells, I went and saw him and said, do you want to play? And he was really excited by it. He said, look, everybody promises $1 billion, but I want to do the due diligence. So he started on his own back doing a series of due diligence checks on our organisation, on our technology. One of the things that we had identified early was a legal risk, because the guys had been with a previous player in the market space. So that turned out to work for us really well. The outcome of that due diligence, and as Charlie mentioned last week, it played out in the Supreme Court, and we won, which was very gratifying. But we gave Tony a significant slice of the company. I said gave.
He's the chairman?
No, Tony. No, he's now on the board. But the idea was that he was going to attract the right people, and in the end, he actually found us the best show.
Now we have to stop the story, so I want to get on to Tim, and then we'll open up to questions. We'll have a good 20 minutes for questions, so you can spark questions around. So thank you very much for Steve. Tim, off you go. Your experience with backdoors and post-listing environments.
I think my story is not going to be as interesting as Steve's, but anyway, press on. So I guess my story is once you've raised the money, you've listed your company or relisted your company, and then it's up to the management team to deliver on all the promises that whoever's doing the roadshow and the brokers made to the investors. And so I guess my message is be aware of that side of the fence as well. Go in with your eyes open. I just want to sort of share some views on that. So spent, in my background, I've spent over 7.5 years at a listed technology commercialisation company. It was originally called QPSX, became Hypernica, and then by strange coincidence became Nearmap. So actually, prior to leaving Hypernica, I ran the acquisition project to acquire Nearmap. So at that time it was an acquisition. In hindsight, that was probably a reverse listing, given that the company transferred into Nearmap. After that, I spent a year at another listed company called Carbon Conscious, which was a carbon play, as COO and company secretary, and then another 5 years as CEO at an unlisted public company with a world-first technology in the mining sector. And so, I'd say even with unlisted public companies, they've got some of the reporting and disclosure requirements of listed as well. So some of the learnings, I suppose, in terms of with that, having that concept of having your eyes open, just a few random thoughts. So backdoor deals don't always go through. So you might end up speaking to a lot of shells and it might not go ahead. So be prepared for that, and you will have done a lot of preparation, gone through due diligences and whatever, and have to progress on anyway, so that's something to be aware of. The costs of preparing for listing, so Rocco touched on some of those. I mean, just as a general rule of thumb, to go through the listing, in my experience, you're looking at probably $400,000, I suppose, and probably more likely $1 million. And then you've got those overhead costs every year after that. So again, probably another $400,000 to $1 million a year to stay listed, to do all the compliance that you need to stay on the boards.
Running the board, auditing, compliance, posting.
Yeah.
Sort of things.
Yeah. So all of everything that you disclose has to be, properly disclosed, has to comply. So you have, company secretary, you've got to have internal accounting, if not legal functions. You've got external lawyers and accountants, and so on. So
plus you're doing it in the public eye, right? So everything you see is public, which might not be to everybody's taste. You have to, I think if you're going to be different by 10% on what you said you're going to do, you have to announce that, no surprises.
Yeah, that's right. So one of the things I said about disclosure was you have to disclose everything that's material to the market. So potentially anything that can cause an upward or downward movement in your share price, you must disclose. So management spends a lot of time sitting around boardroom tables working out what to say. So if you're telling the truth, but so you're not giving too much away because you've got competitors as well. So I mean, the comment I had was fighting with one hand, tied behind the back. And that was one of the experiences we had at Gunningham was, we were doing patent enforcement as one line of business, and so as we were doing patent enforcement, we were also telling the person on the other side what we were doing. So just be aware of that. There's lots of reporting. So you've got to do an annual report, and someone's going to draft that. The CEO has to be involved. The CEO has to be across financials as well. So if you're not finance literate, you need to become so in a hurry, and it's going to take up a bit of time. You've got quarterly reporting, you've got half-yearly reporting, you've got AGMs, where shareholders may or may not turn up. You've got shareholders phoning you up, wanting to know what's going on in the company, and if they're a shareholder, they've got a right to talk to the CEO, so you need to devote time to that. The market, hope I'm pressing investor relations. So again, the market is focused on financial performance and is quite short term. And as the brokers say, the market likes to see news flow. So investor relations, you need to know, you've got to have news flow effectively to keep people interested, keep people buying shares, preferably at a higher price, and avoid the phenomenon of gravity. So in the ASX, most public markets, all public markets, is the concept of gravity. So if you don't put your news flow out, you don't have performance and results, gravity takes effect. And the impact of that is, if you need to raise money, you're raising it at a lower price. So if you're actually doing something really good, like the share price is going down, you risk people buying in that you might not want to come in and have some control of the company.
Buy on the rumour, sell on the fact.
Yeah.
Right, should we leave it there?
Yeah,
Well,
sure.
I think we'll go over the questions now. Thank you very much for those perceptions. I'll just throw it straight over to anyone who wants to fire a question. Yeah, just say your name and who you're directed to, or
Sure.
the
So
panel generally. Or
I'm Matt Harley from Click and Networks. And I was just, Rocco, I was wondering if it takes more time to do the DD on an RTO, too many acronyms, but why would you do that versus an IPO?
Okay, so there's two. I guess there's sort of two main advantages when you're going towards an RTO. First one is to be listed on the ASX. You need at least 300 names in shareholder spread. So when you're doing an IPO, you need at least 300. With an existing shelf, you've actually already got those. You've got a number of those. Obviously, there's going to be a bit of a crunch that happens. So you may have 1,000 shares on the register. They may crunch that down, 10 times. You're going to have 100 shareholders. That 100 shareholders is it's quite a large task to actually get 300 names. So that's sort of the first thing. The second thing is with the IPO costs. To get to an IPO prospectus stage, you basically need to raise seed funding. Probably you're looking at about 150 grand, 200 grand that you are going to raise. You've raised that. If you can't go ahead and raise those funds, you've then lost that seed. Whereas when you're dealing with an RTO, the existing company is already listed. You're doing a placement to fund. So in order to fund the actual RTO process, you're doing a placement in that company. You then got shares. Most of them aren't that liquid, but at the end of the day, even if you invest in at 1 cent, you can more than likely sell them at 0.5, so you at least got half your money back, which nowadays is probably considered a win. So.
The spread is the main thing in an RTO versus the IPO.
can you explain spread quickly?
Well, Rocco, it's existing shares. deal we did, we had 700 shareholders already, so
Yeah.
we didn't have to go out and find them, because they were already there, we already had cash in the bank.
Right.
And we did the deal where we said, you've got to give us $2 million, free money, risk money, to go and build our technology, and if we can't build it and prove it to you, you lose it to you. And they did the deal. So we got $2 million worth of free cash to go and prove to them that we could actually do what we said we could do, and actually fly high, fly fast, and capture. So that was what we did.
Matt?
Yeah, I'd just like to sort of raise the point of people thinking that a RTO is an exit and what that really means for the investors. And so from a shareholder lockup perspective, what's typical from your experience? I've had some experience in it. And also, when might there be an exit? How can people, because of the liquidity issues, how can people actually get their money if they think the business is worth that much 2-3 years down the line?
All the shareholders, all the major players in the VEN are escrowed for 2 years. You can't get around that.
Escrow meaning you can't sell for 2 years.
Yeah.
Yeah.
So what we did is we had.
So that'd be your situation right now?
Sure, absolutely. So we had in a private company that we vended into the public company, we had 24 shareholders. And all 24 are escrowed, but some are escrowed less than others, simply because they put in some money earlier and they were over the 12-month period and at the price they paid, so they weren't escrowed. So, but the board or the directors, the original guys, we're all escrowed for 2 years. Now that's fantastic, because you don't want, it's not an exit. You actually do this because you want the cash, you want the bona fides of being a publicly listed company, you want all the benefits of it. And yes, Tim's right, there's a whole lot of compliance and governance issues that if you think you're going to remain a nimble startup, then think again. It does come with a whole lot of heaviness, and you need to actually manage that really well.
And after 2 or 3 years, if you own 20% of the business, if you're a founder,
Yeah,
how do you get
after
out?
2 years you can sell, because it's online. You sell on market if you want it. Now, of course, it just depends on the status of the business and what you've actually negotiated with all the people.
It's exactly what Tim said. Like you basically get to the point where it's always like the truth serum. You can say whatever, you not say whatever you want, but you know you've really got the directors really have almost 12 months to go ahead and achieve those tasks which they did say when you actually gave them the money in the first place. So as an investor at the start, you basically have that right to sell any time up to that 12 months that they don't execute on that. Then in 2 years' time, effectively the founders, if they haven't delivered, then obviously they may have ended in a business at 10 mil. It's probably going to be worth 1 or 2 mil, and sort of rightly so. And I guess that's the take. But if anyone that is considering doing an RTO, you would be very cautious. When you are approaching these shells, it's probably not the best idea to actually go ahead and say, look, I want cash back. You really need to be looking at equity, because most startups nowadays there's a whole heap of sweat equity and there's a very little amount of actual physical cash that's been invested in these things. No disrespect, sweat equity is obviously very important as well, but it's not actual physical hard cash. So therefore, when you are going to these shells, you do want to actually go ahead and say, look, you are willing to take that bend as opposed to taking out cash, because cash is king at the end of the day, and people want to see that in your business as opposed to in your pocket.
The other thing with an exit, I would say, is that, using Matt's example, if you've got 20% and sell it down, by definition, if you're trying to sell that on the market, you're going to be pushing down the share price as it's selling. So typically when you have founders exiting, you should really develop a strategy.
The market will know, right? There's significant shareholders have to disclose.
Yeah.
Business News will go and put it on their director's interest thing. And go, oh crap, the director's selling.
Yeah.
He's paying
Right. So
People like that bloody media.
yeah.
I'm working with a company at the moment. We're looking at a possible IPO or RTO.
Yeah.
It's a core business. It's a cash cow business. It's been around for quite a few years, generating really good profitability, but on a growth trajectory like that. There's probably 2, possibly 3 other businesses with a lot of synergy, some common investors that we're looking at putting into the same vehicle. Of course, the issue is how you give the respective valuations, because this will always be, it's going to grow like that, but it'll pay the bills for the next 4 or 5 years until the blue sky starts to be delivered. How much flexibility, the way we're looking at addressing the valuations is with milestone-based allocations. what are the limitations around how significant a percentage of the equity of the company could be given to milestone allocations, given that they could be quite significant if these businesses deliver?
Rocco, you want to take that?
Yeah, there's actually, I guess there's sort of no limitations on that. It really is depending upon what your company is actually comfortable with. You know, if you're comfortable with giving away 90%, not giving away, but raising, doubling yourself down to 10% and raising 90% of equity in cash because that's what you do need, then no problems at all. It's probably not the best sort of corporate strategy, but from that point of view, that's fine. But you do need to make sure that once you then, obviously, you either take the point that you become listed in your own right, and then you use that equity to go ahead and acquire those companies in which do have a
They will be part of the vehicle at this stage.
if they're part of the vehicle, then obviously it depends upon the mix. I mean, whatever you think you can acquire them for in a private entity, almost triple it, because that's what you're going to get on the ASX. That's almost some of the valuations, that's how they are. So it really, obviously, that is governed by, once again, like I mentioned earlier, the peers, and like what others in your space, if they are listed on the ASX, what is their valuation? So from that point of view, if you're able to look at their valuation, you then actually know what your valuation is, and you almost know what to actually acquire the other entities at.
I suppose it concerns how big is the blue space. So are you prepared to give away significant, will the market tolerate significant allocations of equity positives in return for milestones, if those milestones are significant?
If you can find the right person and the right broker to actually go ahead and raise that money and achieve those milestones. I think milestones are great. Like I said, everyone will talk about how good the company is, so put the money where your mouth is, and the fact you're willing to do that, I think that's very important. Probably you have a better chance now to actually go ahead and raise those monies than actually, 12 months ago, or actually maybe in 12 months' time. So the market will tolerate whatever anyone is willing to invest. It's just really a matter of finding that firm who's willing to raise the funds at that particular valuation.
You can do a much better deal if you actually incorporate milestones in the whole strategy. So our VEN was broken into 4 sections. So there was an upfront chunk of shares, and then there's milestone shares over 5 years, up to 5 years. But they can immediately vest if the share price gets to a certain level. So you can kind of negotiate your way around anything that's very reasonable. I wouldn't get too hung up about the equity that you have in the public company. It's more about the share price. So just perform when the share price goes up. And the other thing about share price, and we talk about brokers, etc. What we did, and this was part of the learning, is we got cornerstone investors. So we completely took away any market influence. So when we did our prospectus, we weren't raising a cent from the public. We didn't have to be at the behest of any brokers whatsoever. We already had the 6.5 bedded down, and in actual fact we've got the next 2 rounds bedded down before we even get to the market. And so the trick is to raise money when you and tell the market you don't need money. The share price goes up, and that's when you raise the money. So you're actually then able to control at what point you raise the money and what share price you raise it. So I think that's the trick also of getting some really experienced capital markets guys on your team. Get the biggest, best talent that you can find, in your team.
Right, advice. Yes, sir.
Overseas for VC, the RTO model, particularly for smaller tech companies, is quite unusual. I just wanted to know your thoughts on what do you think it is about the Australian market that loves publicly listed investments, and do you think that is a help or a hindrance for VC in Australia?
Yeah, definitely is. The most recent one that we did was XTB Networks, so that was a company based out of Silicon Valley. Shareholders from UST Global, which is one of the largest. Had a whole heap of guys, and we were quite lucky in the fact that the CEO was actually Australian, and so to actually pitch the idea of him coming to list on the ASX was very, very easy. We were actually the second Silicon Valley investor. The first one was One Page, but which is going great guns. It's amazing. But from that point of view, really trying to explain to these shareholders, hey, first of all, the RTO, the backdoor listing, has a negative connotation in the United States. It is unheard of, and people are like, what are you talking about? The biggest thing overseas is they're all about private funding. So in the States, it's very easy to raise that first $500,000. You'll go to the founder of Twitter and he'll put in 10 grand or whatever it may be, and you can use his name and all that stuff. That's the easy bit. The next bit is the Series A and the Series B rounds of funding, and you'll sort of hear that if you do look at overseas investments. That is the hardest bit. They find that a little bit harder. Therefore, in being able to encourage these guys, and for us, we knew we'd be able to raise, we raised $6 million. We knew we'd be able to raise sort of the $6 million for XTB Networks. Being able to say to these guys, hey, come public, this is the value, you're raising on a $15 million value, we can get you a $20 million valuation, we can get you milestones, we can get you the $6 million from that point of view. Then they start to change their tune. And it's kind of, it's really those guys that are really precious about their company that think, I'm not giving it away too early or whatever that may be. At the end of the day, cash is king. If you want to see what your company can do, take the money, let it run, let it ride.
It's behind the question though, which I sort of maybe I'm reading between the lines too much, is because there's a lack of funding options, a lack of VCs, angel funds don't quite get, yet, there's this lack of money, that therefore you're forced to look at RTOs, and maybe a lot of people shouldn't.
Yeah, and it's the education
part of the
My theory is
as well.
because Australia has a really high share ownership rate.
Yeah,
So we're like 30%. But for some companies, justifying the listing fees is just
It is expensive.
Yeah.
You do, even the RTO, one of the things that if you're considering it yourselves, one of the things that you have to do in that negotiation phase of actually the due diligence leading up to the actual deal that's done, is invariably 6 to 9 months. So you need to have cash that you've raised privately, because it just dwindles, because in the meantime you've still got to run a business. And in our situation, all the guys had other jobs while we were kind of doing this, and then we had to bring them out of those other jobs and start to focus on what we needed to do, because then you're real. And so we had to raise cash. We raised $850,000 behind the scenes as a private company, just to fund the process of actually moving forward to do the RTO. And I think that RTOs, whilst it's a lack of cash in the capital markets in this country, like alternate funding, hopefully this is what these initiatives now are about, etc. But most of it's because of the unusual balanced hedge towards mining in this country. Mining seems to have the most creative way of doing things. Even in Western Australia, the creative ways of backdoor listing, the guys in the eastern states that are at the ASX really look strangely at the deals that are put up, because it's so, we find creative ways of doing things over here. The deals that are done are phenomenal, whereas the guys in the eastern states look at this and go, oh, I'm going to prove that.
Yeah.
Somehow
For creative, you mean dodgy?
Mate, me, I'll never do something like that.
But the ASX...
It's got that connotation though, that's the negative connotation.
It does.
Those weird guys over in the West.
It is evident, like the ASX, so every time you did a reconstruction, you did an IPO, it had to be at 20 cents. The IPOs are still at 20 cents, but now when you do a reconstruction, you can actually get it for 2 cents. So XTB was the first 2 cent waiver that we actually did. The problem, I guess, with that is, as a speckle. Yeah, the penny dreadful, that's right. And so it's a perception. At the end of the day, the valuation of the company is still the same. But to, I guess, sort of finish off answering your question, history does repeat itself. Obviously, in the tech boom, mining comes to becoming tech, and the mining boom, tech becomes mining, and whatever period history decides to call this, obviously we're flipping out, we're going mining to tech. So everyone has a history of making money in those particular things. Therefore, the gravitation towards, I guess, sort of RTOs and actual public listings is probably there.
Yeah.
Great. Feels a lot the same.
Do you see the ASX tightening down on these types of things? Because obviously we've gone through the junior mining boom. A lot of companies gone. If we do the same with the tech boom, the ASX and ASIC and all that don't like companies just listing, burning potentially mum and dad's money, because that's who invest in these little penny dreadfuls all the time. So do you see that becoming harder in like 12 months' time? They're just going to start looking at, no, you can't do it this way.
Try to Tim first. What do you expect?
I don't know. I mean, I think the answer is it depends, because in a lot of ways they've made it easier, as Rocco was saying, to do RTOs. Why? Probably because technology industry needs funding. So I don't know. I mean, it depends, I suppose, whether there's going to be some success stories that come out of it. I think there already are. But there's always going to be, crash and burns as well that get some press and scrutiny. So yeah.
Did you find that like when we had the second board, that sort of failed because there was a lot of companies that came and went and everything like that? So the ASX is going to be very, mindful, I suppose, of not trying to create a lower end of their market in that.
Well, they've got to be competitive as well, because I mean there are other boards that can list them.
Yeah.
So you go to Singapore, you go to Frankfurt, you go to the US, you go to Canada. So they they've got a market as well, which is the investors in their market, and they need to be competitive. So if they lock everything down too much, they potentially lose the business.
And there's strict guidelines. I mean, I don't think they can just have on a whim decide that they're not going to approve this anymore. Essentially, there are chapters 1, chapters 2, you've got to comply with them. And if you comply with it and meet the requirements, then there's no reason why this won't continue.
In January, there was the ASX sent back 17 lodged prospectuses for a query, and some of them were just very small sort of queries, but 17 were sent back. So they are, they're very hard for them just to say no, but they are sort of coming back with more and more queries and are introducing into independent accounting reports, and like I said, all the books must be audited and everything along those lines there.
So the private entity needs to be audited now. That's a stricter rule than it was before.
And just on expectancy, one of the things that we've just found out that's it's a negative about an RTO is that when you're off the boards for a period of time, that triggers a new rule called cleansing prospectuses. So it means now that any time we do something like, say, I did a deal with Charlie and pay him in shares or whatever, then that needs to be cleansed, but it now needs, if you're an RTO for the first 12 months, you've got to issue a cleansing prospectus. Now, it may not have to be the whole 100-page document, but it's still a significant burden on the company to do that every single time.
That's $7 grand a pop. So, time for maybe 1-2 questions. So we wrap up about 8:30. Burning question about this topic, Sergio, and then Rob.
Yeah, how have you found the management of existing shareholders done the RTO? These guys have been months of days and burn their life savings in the junior minor and high hopes. Are they value for you, or are they kind of taking out their frustration?
I'm happy. Yeah, we're fortunate because there was 700 pretty pissed off shareholders. To be quite honest, they put in money. I mean, the White Star Resources began its life in 2007 as Winner Resources and raised 3 million, then raised in 2011 9 million. They were copper plays over the world and lost their money. The board got rolled and someone came in and essentially the whole thing started to rebirth again. So they were looking for a project. We came along and they've got sixfold on their money already. So no, we don't have anyone that's so we're pretty happy.
That's fortunate. We had Liberty Resources, took a stake in that, and at one stage we had 6 directors, and these directors have written the company down from about $2.50 on the back, back $2.50 down to about 2 cents. I think we sort of went in there at about 1.2 or whatever, and we sort of said, look, the direction of the company is tech. These guys are like, okay, yep, no problems at all. Kept fighting. At the end of the day, all they want to do is just sit there, get their shares, get their cash, and basically just have a corporate credit card. So that's the hardest thing, getting rid of these guys here. So in the end, we called the re-election, obviously got them voted, they were voted off, the shareholders decided to vote them off, and then things can move forward. So from that point of view, that's probably the hardest thing, dealing with those incumbent stale directors who still think they're entitled to something, and even though they've sort of seen the stock.
But that's the deal that you've got to do up front. You don't get to that point. We actually did the deal in the negotiation where we only allowed them to have one director that we wanted of our choice, and she was sensational. She was the most experienced company secretary we've ever found. So we actually not only got somebody we really liked, but had serious talent that added value to our business ongoing.
So you guys are the white knights coming to the rescue.
Absolutely, yeah.
Down to the stress. Last question.
To be honest, I haven't really been following it.
Right, okay.
Yeah.
I wouldn't say so. I think it's probably everything's just stock standard. You know what you need to do in terms of obviously getting a prospectus done, getting the reports done from the legal point of view and actually from the accounting point of view. I think once you sort of have all that, they have actually relaxed a lot of the rules. Before it was actually about 400, about 400 to 450 shareholders to be a safe spread. Now it's about 300. So that certainly has helped. There's a lot of talk that they are going to reduce the 20-cent IPO limit down to a 2 cent. I don't think it's going to happen given the fact that sort of recon is now the 2 cent limit. But I guess they are sort of trying to make it a little bit easier. And at the end of the day, ASX is a business in themselves. They're listed on the Australian Stock Exchange. They want revenue, so they're going to try and do what they can, but obviously they still need to maintain that integrity. So.
Also profit history, there's a lot of perception that you need a whole history of profits. They don't insist on that anymore. Right. So you can just sell a story now.
Yeah, and that's where the 3 million net cash comes into it. They want to make sure you've got enough to survive for 2 years.
Timing is everything, Louise. Trying to be as objective as you can. Is this a great time to be doing RTOs? Are we sitting in a time where it's just like you said, it's flipped, and it'll be like that for a while, so people should look at it seriously? Or is the time running out? Is it we've gone past that time? And maybe it's not such a great time to be rushing into these things.
I think IPOs are making a comeback, but there's going to be more and more shells available. Obviously, all the shells that are available are the mining shells, and as time goes on, as these commodity prices do not continue to bounce, or even as sort of demand doesn't continue to bounce, I think there'll be more and more shells available. You can get them a lot cheaper as well.
All right.
I don't have a very good crystal ball, but yeah, look, I think it's a great time. It has been since the sort of mining came off the boil to free, and everybody the appetite changed to tech. So for the tech and innovation space, it is a good time. There is cash around. People are looking for something, and how long that's going to last, I don't know. Look, at the end of the day, business principles will always apply. If you've got a strong case, if you've got strong intellectual property, if you've got strong business, you've got strong people, the money will be there wherever you are.
Yeah, I agree with these guys. I think it'll last as long as the mining stays off the boil. Let's be realistic. So as it starts bouncing, I think all the traditional investors will jump back in. But for the time being, it's good for the technology and innovation industry. I think we're developing a lot of experience and getting good capital into the sector.
Right, guys. So hopefully you can stay around for a few more minutes. You want to come up and meet these guys a little more and network. We've got the room till 9 o'clock. Can you just thank the three for coming on today?
Well, thank you, Charlie, very much for arranging that and for being a wonderful host. We do have the space until 9, so I encourage you to meet each other, meet our presenters this morning, and also I encourage you, if you're sitting on a folding chair,